Welcome to the 1:30 session, Rationalizing Blockchain for LPs. I think if you look at the AUM and flows right now, there's not too much successful rationalizing going on, so we may stray from this topic a little bit. I want to give everyone a short chance to introduce themselves and with a numerical quiz, or rather a pointed question, which is if you were allocating, $10 to digital assets, like how much of your conviction is in the crypto tokens themselves versus the RWA trend? And I'll just give like a brief intro of VanEck and where we sit on this. So VanEck is a family-owned mutual fund and ETF sponsor here in New York. Jan VanEck owns the firm. His name is on the door. We have a long history in natural resources and commodities. We're a macro shop with kind of an Austrian economics background. So we got conviction 5 years ago that Bitcoin would disrupt traditional finance and our significant gold holdings. And we went about trying to bring a Bitcoin spot ETF to market, which, as you know, has not succeeded. So we pivoted and started writing checks into venture to get smart in the space, and then launched more than a dozen crypto strategies, including crypto ETNs in Europe and 2 private funds in the US, 2 token funds, one of which I manage. And as the liquidity environment has gotten tighter and treasury yields have gone up, we're certainly writing fewer checks into venture and fewer direct private investments, and we're consolidating our efforts on where our core conviction is, which is that these decentralized assets are a call option on a different financial future. And if that happens, then we're going to see big time number go up in a handful of tokens that have attractive microeconomic structures in winner-take-all markets. And so our conviction is like 9.5 on decentralized crypto assets and 0.5 on real-world assets, and think that these real-world assets are going to be, the lubrication of the next bull run. People who make money in Bitcoin when Bitcoin goes up and look for other things to recycle those assets into, they will hopefully benefit from all the plumbing that is being built by all of you in the room. But from our perspective, as a highly regulated TradFi institution with frequent conversations with the SEC, like what is the benefit of trying to get into these security token models that just can't be transferred, that have to be held in qualified custodians if you're a US manager? So my conviction is very low. I'm here to kind of strawman the bear case and hopefully hear from some of the innovators on this panel who can change my mind. So I want to just start by going kind of down the list. If you can kind of intro yourself and give that like relative conviction, that would be helpful.
Hi, everyone. Collin Erickson here. I'm the CIO of Anemoy. We manage a variety of asset strategies, and I formerly was at Victory Park Capital, where I ran special situations and credit investing strategies in addition to their digital asset strategy. You kind of started off hot there, Matt, but I'd have to go with like inverse to 3 to 7. I think that a lot of what we're doing here is infrastructure related, and I think a lot of the tokens are really just speculative gambles. And maybe it draws in interest, but the sustainability supporting those token models has yet to be proven. Obviously, we've yet to prove ourselves here, and there are a bunch of legal, operational, technical considerations that we have to sort through as well.
Great. So Rob Hadick, I'm a general partner at Dragonfly. We're a $2.5 billion AUM, like crypto native, mostly venture fund with some kind of long only liquid strategies as well. Very bearish for the first 2. Listen, I'm not as bearish or nearly as bearish as Matt here. I will say, the best risk-rated return in crypto right now, from my perspective, is still ETH. And so, like, if you're asking me where I'm putting my money, it's definitely heavily weighted ETH. But I think the reality being that it is clear to me that RWAs, like what I hate the name, but the infrastructure we are building for bringing off-chain assets on-chain is going to be important, and there is going to be value accrual to that space. I think the reality is institutions move slowly. Institutions are driving a lot of the adoption here, and so there's been a lot of, I guess, impatience around crypto or things coming on chain, in part because we've been having this conversation since 2017, or even like Blythe Masters was on Fortune, I think it was in 2015, blockchain, not Bitcoin, and it was a lot of the same conversation. But I do expect that this train is going to continue to roll.
Cool. And we need the 0 to 10 grade, please.
Oh, I don't. 7-3 ETH. I don't know.
7 ETH 3. Anything else? All right. My name is Leo Mizuhara. I'm founder and CEO of Hashnote. We're a on-chain first asset manager. Formerly, I was Deputy Chief Investment Officer at Bank of America, and then I ran the Systematic Options Group at DRW. So as to the question at hand, it's an interesting question because you can't index, right? So I think there's a lot of really deep value in tokens right now. There's some stuff that you just have to look for the stuff that's economically viable, which is almost none of them. But I think there is some deep value there, which is probably the best buys. But same with real world assets, which I also hate the name of because those of us in finance called those asset-backed securities, and RWA stands for risk-weighted assets, right? But I think it's the same in real world assets where you can find those gems that are actually of value and have higher risk reward than the TradFi counterpart. They're just really hard to find. So that all said, for the numeric values, I think now I would be 70-30, but also 70 in the tokens, 30 in real world assets, just because there aren't enough of them. Like they're hard to find, and you could take them all down probably at a place like VanEck.
Good. My name is Carlos Domingo. I'm the co-founder and CEO of a company called Securitize. This is a bit of a deja vu moment for me because this conference existed 5 years ago and then it completely disappeared, and then they have reappeared with a different name but talking about the same thing and seeing some of the same people. My company was one of the pioneers on the whole process of tokenization and how to issue digital asset securities or security tokens, which the new narrative of real assets for the most part refers to that, because obviously when you want to take a real asset and put it on chain, is either a fund or is let's say a plane or a house that you have to securitize and then issue securities against that, and those are like regulated instruments. We're one of the first companies that registered a transfer agent to manage tokens that represent securities on chain, got a broker dealer, and ATS, all approved for digital asset securities. And in terms of what's my belief in the space, obviously I'm pretty bullish on tokenization, but we can discuss about the reasons for that. But in terms of allocation of crypto versus real world assets, the question to me doesn't make any sense, because real world assets doesn't mean one thing, right? So it could be you buy a house, that's a real world asset that maybe you tokenize the title and put it on chain. You can buy a private equity, you can buy credit, you can buy money market funds. There's so many different asset classes there. From a personal experience as an investor, I keep 70-80% outside crypto and the rest in crypto, because crypto is very volatile, and it's also, there is a lot of instruments there that I don't think that make any sense. I think I also don't like the real world asset term, but the only thing I like of the real world asset is that it distinguishes from the rest of what crypto has been doing the last 2 years, which is imaginary assets for the most part, of issuing tokens that don't make any sense. They're not backed by anything, and they shouldn't actually exist. Like one of my investors says, they're friction tokens that people do because it's a proxy for issuing equity where they can raise money from retail investors and get liquidity very quickly, but it really doesn't actually add any value, right? So I'm trying to stay completely away from that part of crypto. I think that doesn't make any sense. It's not productive and it's not sustainable long term. There's a lot of valuable things obviously in crypto, and the infrastructure obviously of public blockchains is what we believe is the future for digitizing assets and digitizing capital markets, and that's what we're trying to do as a company.
Yeah, can I ask a question? I guess another way to phrase your question, I think, is if you take the token world and compare that to equities, what is your percentage of equities versus tokens? And then for like the more fixed income or asset-backed securities world, what is the fraction of traditional asset-backed securities versus tokenized asset-backed securities, right? Because those are the real trade-offs if you assume that token is a lot more like equity.
Fair enough.
Can we do the bull case for tokenization? Because you said the bear case.
Go for it.
So listen, first, my background has nothing to do with financial services. This is I have a PhD in computer science. I've always worked in tech in different industries, but this is the first time in the last 5 years that I've kind of, got into financial services and understand capital markets. And the first shocking thing as a consumer before understanding how the plumbing works is that how outdated and inefficient it is. and it's shockingly inefficient. Like before my previous job, I had shares from the company I was working. When I quit to move into crypto, I had them in a portal run by a company called ComputerShare, which I had no idea who they were. And then when I left the company, I just want to get rid of the shares because I didn't believe in the company anymore. And it took me like a month to do it. And in my simple mind, you'll think, well, I see the shares listed in the portal. I should be able to click there and sell them. This is a publicly traded company, and get rid of them. And it doesn't happen. Why? Well, because ComputerShare turns out to be a transfer agent that actually manages the securities in a very inefficient way, that then to trade them has to transfer them to a broker dealer, which takes weeks for an unknown risk or lack of infrastructure of moving the asset quickly from one place to another, and then the broker dealer has to then verify your ownership, take it to exchange, trade them, and then you eventually get the money through a wire transfer, and the whole process takes weeks, right? So if you think about why this is so inefficient, is for two reasons. One is lack of digitization. Sometimes, like, don't have good systems to manage things, and the second is because in capital markets, the securities and the cash, which they need to interact with each other to trade and to move money in and out, they sit in different ledgers. They're completely disjointed. And then to make sure when a trade happens, it settles and the money moves and the securities moves and there's no errors, they have to synchronize all these different ledgers and different intermediaries, and that's what makes it extremely inefficient. So blockchain, if you think of blockchain as just basically this massive public ledger infrastructure where you can actually write things and identify ownership of things, allows you to use the same ledger to represent securities and cash with the same infrastructure, and then allows you for extremely efficient ways of moving them around and trade them with each other. So that's kind of interesting because it provides efficiencies which don't exist before. So that's kind of like the base level. The second level is that because of these inefficiencies in capital markets, especially on private capital markets, a lot of investors are out of the market. They don't have access to the market because unless you are of certain size, of certain amount of money, banks don't want to deal with you because they lose money, right? Like one of the banks that I work with, unless your account is $20 million on the wealth management side, they don't get commission because then they lose money with smaller customers. And that means that, it leaves a ton of people outside, private capital markets where a lot of value creation happens. So democratization of investing, it's something that blockchain can actually bring through tokenization and through, these assets, securities or real world assets. And the third one is that, and this is still not a reality. The first two are kind of a reality already. The third one, which is still not really a reality, except for some cases like Arca and CJD there, because we had this conversation at lunch, is that you can actually make a financial service product better by tokenization. So you can think of a money market fund where you have instant redemption. Where in traditional money market funds, you don't have instant redemption. And that's because you can basically swap the token that represents securities by, minting USDC, which is, cash on chain, and putting that on the treasury and then, sell the security after. You can, do instance issuance. You can do more efficient trading. You can do lending by facilitating how you, identify the provenance of the collateral, seize the collateral or liquidate it, etc. So these are features that a lot of financial services products out there don't have because of the lack of infrastructure to make them in an efficient way. And only really, really large investors have access to those, and smaller investors, they don't. So those are the three reasons why I'm bullish. And of course, a lot of the stuff happening in the industry today is at the basic level of, let's just make it a more, a better ledger and a better, tracking of the beneficial ownership and stuff like that. But as we build the different blocks and, people get licenses to operate in a regulated world, etc., then all these other, advantages are going to manifest, and this could be very revolutionary for capital markets. So
I think that kind of depends on your definition of bullish, right? Like, I completely agree with you on all your counts. I actually tell the exact same story when I'm talking about what tokenization of real world assets and securities. And, honestly, I think 10 years from now, every financial asset in the world will settle on chain. And so I think that's a very
bullish, but I'm not that bullish.
Well, sure. But I think that's a reasonable case, but I don't think there's anything to invest in right now. So if we say bullish real world assets, what would you buy right now on chain versus off chain? And I think
you can buy from us private equity healthcare fund from KKR.
Yeah, but I'd rather do it not on tokenized form.
Well, no. But the difference is that the non-tokenized form, and this is a real example. So this particular healthcare fund from KKR, if you buy it in non-tokenized form, there's only two ways to buy them. You buy directly from KKR, which you have to be an institutional investor. So I'm assuming you don't have enough money to buy directly from KKR. Or you have to be a customer of the wealth management of a large bank, let's say Morgan Stanley in this case. And then you have to invest $500,000 minimum ticket, because otherwise for them it's not economical to send you a smaller position. You have to go through hoops of paper to get the investment done. It takes like 2 weeks for the securities to show up on your account. And when you get them, they have zero liquidity and you can't borrow against them. So the tokenized version of those have lower minimums because it's all digital. So you can actually don't care whether you sell 50,000 or 500,000 because it's the same cost to do it. So you can actually lower the threshold of entry. You can, provide some degree of liquidity in a more efficient way because tokenized form allows you for more efficient settlement of trades and price discovery. And eventually you can do lending against the tokenized form. So it's actually not true. So
we're way off the rails here, I think, a little bit. But while what you said is all theoretically true, like none of it is in actuality true today, right? And I think that's the point that Leo's trying to get at. A portion is true, yeah. Yeah, is that there is no liquidity on chain. There is a data problem right now. Like nobody can go and like buy a piece of the healthcare KKR fund because they have no idea what the underlying assets are. Like an institutional allocator comes in and they diligence the portfolio, right? Like somebody who is an accredited investor wants to come in and they want to look at KKR.
No, that's not true. So to sell securities, you have to have a prospectus that describes what the underlying assets are, and then they do quarterly disclosures as well. So otherwise it will be illegal. So.
I agree with you. What I'm saying is that for the democratization of private equity right now, the investors who would invest in that either are already institutional enough that they meet those minimums and that they understand what they're investing in, or you have people who don't understand what they are investing in or are not sophisticated enough to underwrite the underlying fund.
I know, but do you think when people go on to Robinhood and buy Tesla shares, do they understand what they're buying? Do they read their filings? Like they have no idea. They just like Elon Musk, right?
The people who are buying Tesla shares are mostly BlackRock, right? And then we're investing in ETFs that BlackRock owns, right? So like it's a fair point, but it is in the private side, there's a significant like selection issue and like a data issue and an understanding issue that doesn't necessarily exist on the public side.
I think like psychologically, right, if you're an investor, you're going to either have to decide if you're going to buy assets on chain or sell assets on chain. It's obviously a lot easier to say, hey, I'm comfortable going to Securitize and letting my fund interest be blown out and distributed to retail that way. But like, do people care at scale? And I think that's like part of why we're all here, right? It's just talking about like what's the actual LP interest in providing flow to these types of assets.
Why don't you share some of your learnings from that and trying to raise capital? Like what's the product that you're bringing to the market that touches this space? And when you're talking to LPs, is that what resonates, or is it like people want Bitcoin and ETH and this is derivative?
So yeah, I think like there's two kinds of capital bases you can go after. One is one that I'm more familiar with, which is the traditional side of things. And then there's the DeFi native stuff. So I'm going to kind of leave that second camp out of this conversation. I mean, I think, when you talk about tokenizing any asset, I think that, Leo and Rob are probably correct in that you're basically just adding a risk premium to that, right? To that asset. So any asset that exists with a traditional capital markets infrastructure becomes a less attractive trade. Now, at scale, if you have multiple asset classes on chain, you might be able to, portfolio optimize dynamically in a way where like Citadel traders, quants are now trading what are presently illiquid assets, and you have a different equation. But today, when we think about a single asset, you just add a risk premium. So I personally think that in order for traditional institutions to become interested, you actually have to find an asset that is uniquely enabled by blockchain.
So can I just comment a couple of things first? Actually, any asset you buy, whether it's tokenized or not, it's represented in some underlying ledger, for sure, because somebody needs to track who owns what, right? So whether, tokenizing it, which is basically just using a public blockchain as the ledger to record the beneficial ownership is more risky than the traditional systems. I'll have to disagree with that, because we've worked with a lot of asset managers that, because they actually use very poorly managed ledgers, they have a lot of problems with reconciliation, with there is a lot of horror stories of companies going public and not knowing who the shareholders are, and people are receiving their shares, and because they don't have a good ledger to track them. So I will argue the opposite, like having them on a robust, cryptographically secure, traceable, auditable ledger is actually a better way of representing the asset, irrespective of what else you're going to do with it.
I mean, it's better, but I mean, like I left a traditional institution because like there's no way reputationally they're going to take the risk associated.
So I was going to get there. So with traditional institutions, anything they hear about crypto is, Sam Bankman-Fried is in jail, Celsius scammers, BlockFi, this and that, SEC suing the hell out of everybody, blah, blah, blah. So there is I think crypto, because of precisely, in my opinion, lack of regulation and lack of self-regulation from the industry has created such a bad image in the institutional world that people don't want to touch anything that is on-chain for that reason. And this is why I think in terms of finding LPs for these products, trying to go to institutions is the wrong approach today. Because institutions are not ready. They also have issues with custody of the asset when it's on-chain, etc. I think you should go to, instead of, there's two options, right? You said, go and find assets that are better than on-chain. Well, the other option could be go and find investors that actually don't have access to those assets to start with. Because then you're creating you're fulfilling a need, right? These guys don't have access to a KKR investment at all, and maybe they want to have private equity exposure. So if I can actually give it to them, then I'm actually solving a real problem.
So I guess I lean toward what Collin was saying to an extent. Like, I think it's, particularly relevant for the people in this room. I think it's really important that we find ways to create instruments that are higher risk reward on-chain than off-chain. And in many cases, if we're just wrapping something that's already off-chain and we're good at that, right? And that's what I'm seeing most of, right? Like 90% of the projects I see that are real-world assets are just not better than the traditional approach. And like as an investor, I'm just like, I'm going to buy all the traditional stuff, and I'm only going to buy on-chain if it's higher risk reward. And there are a handful of those, and we should be focused on those. Now, as far as the investors, like focusing on different investors goes, I'm of two minds on that. I think that it's important for us to democratize access to a lot of these assets. The unfortunate thing is that most people don't have the time or expertise to do any of that due diligence or understand the material they're buying. There is a small number of people who are, like, 22-year-old me had tons of time to like research securities and figure out what I want to invest in. But, currently, actually, I have more expertise, but less time to invest my personal account into, esoteric things that I might now have access to that I didn't have before. And I think that's the true with the majority of people. Like, I bet the people in this room, I bet you're all pretty sophisticated, but I bet your PA does not look nearly as good as like my institutional holdings. So I think that's a difficult argument in terms of access to people. But all the same, like in terms of the ecosystem, for sure it's going to all end up on chain, because I think that it is much more efficient, much more transparent. It gives you features like composability that are going to be huge. But yeah, the things aren't there yet, and we all have to build that now.
So I agree with that statement, by the way. I see a lot of projects that they're just buying an existing asset, wrapping it around an SPV, adding 50 basis points, and selling a token second. That makes no sense. That makes no sense at all.
Well,
that's actually
it might make sense if there was actually a centralized hub for liquidity, but I think one of the issues
but the underlying assets that they're buying are liquid already. So
yeah, but the customer, I mean, there's 8,000 ETFs, right? There's more ETFs than there are stocks. Like, the customer can go and discover what ETFs are interesting, as long as they're all trading on the same exchange. They all have the same disclosure parameters, and I feel like from our perspective, that's one thing which is really lacking. Like, if you're an originator, you don't really have conviction that the asset is going to find an exchange with critical mass. And if you're a buyer, you worry about your exit points. So I just wonder, maybe some of you can help share your views on the prospects for liquidity to find some more centralization and volumes.
I mean, has changed. I can tell you why there is no liquidity, at least on mine. I think that there is a chicken and egg problem, right? Because liquidity, first, you're talking about ETFs. I think that the reason we focus on private markets and not public markets is because I think public markets, with all the problems they have, for the most part, they work, right? They're liquid. You get the impression that when you're buying something, you're receiving it, even though you don't. But anyway, it's just like the UI makes you think that you own Apple shares when you actually don't own them. And it's good enough for most people, right? And you want to open an account in Robinhood, it takes 5 minutes and you're up and running. And so that doesn't exist for private markets. And private markets, I think that the view of saying no, because private markets are more complicated to understand for investors, we shouldn't have access to. I think this is a very paternalistic view that I don't agree with it.
Also, public markets aren't that much more.
Well, like I was going to say, like public markets, like 90% of retail people investing in public markets, they have no idea.
Yeah, I mean, there's like, I think we're talking about like two different things, right? And we're like, Carlos, like totally understand when you're talking about like democratization, like extra new access, et cetera, right? Like that makes complete sense from where we want to be, right? And there's this like idea of where we want to be, and there's the idea of where the space is today. And I think it's clear today, if you look at the way the market has reacted to this space, that they don't see on-chain access as less risky. They don't see it as better than the current alternatives. And for instance, like let's just
do you think that would be true if Bitcoin were going up, though?
Well, the hacks are
that's a different
nonstop,
question.
right?
But just to finish the point, which I think is important here, is like if we look at how the layer one treasuries are allocating their DAO treasuries today, they are taking cash from investors and they're going and putting an account at BlackRock. And they're not taking their money, putting it in USDC, and then going to any of these products and saying, this is how I get my yield. I want to be on chain. And so even the people in the space are saying, on chain today is not the right access to capital for me. And it's not the right place for me to get yield. Right. And that is the problem. And we want to get to a certain place. And I agree with you. I think we all believe in that. But it hasn't been where people have felt comfortable allocating capital today.
Analyze what you said. They prefer to put it with BlackRock than on chain. Why? Because they trust BlackRock. They don't trust a DeFi protocol putting things on chain. And I 100% agree with that. I don't put my own money on a DeFi protocol, things like that.
I have a lot of my money in my assets.
Every other day. No, I'm talking about the treasury of my company, which is not my money, it's my investors' money. So I need to be a bit more careful than my own money. But what about if BlackRock actually put their fund on chain?
That's Matt's
investing on
point about
BlackRock,
centralization, right?
And then on top of that, you have better features. You have instant issuance, you have instant redemption. You can come in and out with USDC and stuff like that. Then that becomes the same, safety net of BlackRock, but with features that make it more appealing for the crypto companies to put treasury. The problem, going back to why there's no liquidity, is because many of these asset managers, which are the ones that really will move the needle, have not come into the play. And many of the assets that people claim that they are tokenizing from BlackRock is actually not from BlackRock. They just buy it on the open market, overlay fees on top of it and put it on chain, which makes no sense.
So we all agree on that, I think, right? And so like we actually do a money market product on chain, but we run it ourselves. We don't wrap somebody else's product, and we offer things like instant redemption. So we're very much aligned in that vision of how things should be, and we're building toward that. But it's not a lot of people who have done that, right? Like our number one competitor has wrapped ETFs.
Leo, how do transfers work under that system? I assume that they're prohibited.
They're not actually. So we've actually worked it out with our fund administrator to use the ledger as the final, like that's the thing that counts for who the token has been transferred to or who the shares have been transferred to.
You're not US.
No, we're US. Yeah, but we have worked it out so that anybody who can own the token has to be on a whitelist. So we've KYC AML'd them. But the transfers happen on chain, and that's good enough because we know who they are and we know that they've kind of gone through us. We are US regulated as a CPO, and we're Cayman's regulated as a mutual fund by SEMA. So we're available both in the US and abroad. So these things are possible. It's just a fair chunk of work, right? That took us a fair bit of time, and we actually have a solution to make this permissionless as well. And we're working on that shortly.
So in a way, you're vertically integrated, right? You become both the exchange and the fund manager, right?
So,
if you're the one who's whitelisting who can transfer to whom, then in a way it's an exchange, and like there was a lack of interoperability with like
it's not
other.
An exchange. We consider it a create redeem. So one person has redeemed, and another person has created, but that just goes like you can track it on chain. And then the fund administrator looks at what happened on chain and says, this is what happened. So, we very much avoid being an exchange. And I want to get back to your question about liquidity about that too. But I think that there is a handful of things that you can do where you're creatively using blockchain to, like, for us, being able to cut that administrative layer out of like having to keep track of create redeems and have your own database that does all that and just throw that on chain has been pretty big. We run our operations with one middle office person. Everything else is done on-chain smart contracts. And it makes, I think when you look at the world 10, 15, 20 years from now, you're going to see that operational efficiency is going to be huge relative to what you see in middle and back office, which is much to your point with traditional institutions. Now for liquidity, I was recently talking to OSL, the exchange in Hong Kong, right? So there are going to be exchanges that allow for these sort of digital securities to trade. Personally, yeah, they exist, yeah. The difficulty, I think, right now for liquidity is that we have this kind of made-up distinction between securities and non-securities, right? Coinbase is a great source of liquidity for non-securities. A lot of the big crypto market makers can market make non-securities. And for some reason, we have this distinction between what is a security and is probably less risky than these tokens that are not securities that people are allowed to trade on these exchanges. that all needs to clear itself up, right? We're going to have digital security markets. Coinbase will probably become one of them, honestly. And I think that'll sort itself out, but it probably takes 10 years of regulatory uncertainty before it figures itself out.
Also, I think fundamentally there's still not enough assets that can trade, freely trade to provide liquidity for secondary market. I think that they're trying to focus on, we own both, by the way, the broker-dealer and the ATS, but the primary focus we do is the broker-dealer and the tokenization part, because we think that until that gets to certain size, the other one will not come, right? So because, to trade something, it's like companies don't go public until they are a certain size, right? Or ETFs don't get enough money until they are a certain volume. So it's the same thing, right? So I think first we need to figure out more stuff that we can put on chain. And once that gets to certain volume, then, figure out the liquidity part.
Yeah, Leo, you've made, I think, a good point that the on-chain assets suffer from kind of adverse selection, and that it's the most novel and interesting investment opportunities are not being underwritten on-chain at the moment. And I would argue one way to change that, and we've seen it through all of these crypto tokens, is you bootstrap activity by providing a token. And I think Centrifuge has done an admirable job of that, but that runs into SEC concerns stateside. So how much would a token help in changing that adverse selection?
I'm very anti that, I'm just going to call it what it is, that Ponzi model of rewards. I think that anything that you tokenize, particularly if it's a real world asset style thing, it should be able to stand on its own legs. Currently, I'm focused on things that are novel uses of blockchain to keep track of the cash flows, really using that on-chain technology and smart contract technology to reduce the fees and make things more transparent. When I think about things that actually add value on chain, right, I'm primarily thinking of transparency. So are you reducing risk by being able to see straight through to the cash flows of your real world asset or securitized product, right? That's not available in traditional markets, so that's a value add. The second thing I think about is composability, right? If you tokenize something, you should be able to compose it with other things in the market. Maybe you can borrow lend against it. Maybe you can actually compose it with an options protocol. Maybe you can compose it with whatever other DeFi things that you can do, and that composability is very interesting. And then third, I think of that kind of trustless component, right? Is there something that's important about the trustlessness? We were talking before, so adverse selection is a part of it, but I'll come back to that in a second. We were talking before about, you guys all remember when during the pandemic, Citadel had shorted a bunch of stuff and people were saying you can't find the bar on that stuff. How could they have shorted that much? Right? That garbage should never happen, right? That is absolutely a blockchain solved technology or blockchain solved problem. If you had all the equities on chain and you probably need some sort of zero knowledge solution so that you don't know who's trading the stuff, but it should be very clear that the borrow existed and whoever the player was found the borrow. The fact that we currently can't show that means that we have a clear problem and this is the solution. So it's there, we're just not doing it yet.
I think to your point though, does a token solve the adverse selection issue? I think absolutely not, right? Adverse selection is happening because of the fact that it is hard to put things on chain and to tokenize them. And so you have to not have an easy path to, getting credit otherwise or whatever the asset may be off chain, right? Does a token solve the liquidity issue? Now that's a different question. And I think that is one where there's more of a straight line correlation to there is more liquidity if people think that there is an economic incentive, and tokens create economic incentive. Whether that's a good or bad thing, I think that's, one of the things we're all grappling with a little bit, but that's where I think there's real, value add potentially for tokens as part of the ecosystem.
I think that the more token shenanigans you put there, the more you're going to scare off the institutional people that really have assets that are interesting to tokenize. So you shouldn't do that. Most of those tokens don't need to exist for any reason. They're proxies for equity, for companies to raise money without following any regulations and to provide liquidity without following any regulations. No other industry does that Every other industry raises money in a proper way, sells equity, eventually goes public and gets listed.
I have a
in
hunch if
exchange, etc.
Centrifuge did a security token offering through Securitize, you might say otherwise.
Well, so if it's a security token, then you're following regulations, right? So it's a very
So in that
different-
case, but the token would help bootstrap
No,
liquidity.
I don't know if the token will help bootstrap. What I'm just saying is certainly the current token models I was talking about today, like many of these DeFi protocols. I want to talk about Centrifuge specifically because they've done a great job putting the conference together, and we used to work with them quite a lot on KYC stuff. But I think that a lot of people need to think about why is that you put the token. Is it really because like let's say for running an L1, the token makes sense, right? Because there's an economic incentive to keep the blockchain secured, etc. But many of the other protocols that have a token, the only reason I can think of is because that's the way they raise money. There's no reason. They don't add any value. They add friction. There's a whole issue with governance. Well, that existed many years ago. People are something called shareholders and board of directors, and so you don't need to actually give a token to get those things. So I'm very skeptic of that, and I think that doing this regulatory arbitrage only scares off the institutional people, which is what's missing in the industry.
No, I just think that like at the end of the day, irrespective of how we want to approach the conversation, like the tokens scare off the institutions, and you have to think about how BlackRock is actually going to do business here. Are they going to find assets that they can't find elsewhere with better risk-adjusted return? Are they going to save a bunch of margin or have margin improvement in their middle office and thus undertake a bunch of different process changes in order to achieve that? Or are they going to sell assets, in which case Carlos' business model is great?
I think, listen, I don't necessarily disagree with any of that from the institutions. I will say we are in this room because of the tokens, or this industry exists because of the tokens. It exists because of the retail participation. It exists because people got excited about this space. For Bitcoin, I think Olaf says all the time, we all work for Bitcoin, right? Like that started, over a decade ago, and that's why we're in this room. Now, I think there's real reason that we want to make it a safer space for the institutions to come in. But if we completely ignore or ostracize like the rest of that market, what are we doing here? Like from my perspective.
So, yeah, I don't believe in token as incentive. I think it makes a lot of sense for the infrastructure, layer ones, layer twos, and such. One thing that I remember seeing, and I think it's something worth thinking about for anybody thinking about issuing a token, is that if you look at the economics of that, it's terrible economics for the issuer, right? Like the cost of user acquisition via token is extremely expensive. It's just that people haven't done that analysis for the most part yet.
Why is it expensive? It's imaginary money, right? They print more and that's it.
Because
it seems to be like the cheapest way of doing it.
Because you're selling your equity, right? You're selling your equity. Like you said, it's equity in your company. Yeah.
But it's not equity, right? That's why they do it, because they can keep printing tokens and issuing tokens. And this is why you see so many incentives of people that will pay you with tokens and stuff like that.
If you print more, you're diluting, right?
You're diluting,
and you're diluting yourself because so the most tokens issue a big clip. You keep some and you take some and use it as an incentive.
But they get to keep 100% of the equity of the company.
Oh yeah, that's fair. If you're not going to have any economic value of the token, yes, that's probably true.
Most
and a lot of those
don't have, right? Like all the governance
they don't give
economic
fees.
value they have.
Yeah.
They don't
I mean, listen, like I think we've all worked at big traditional financial shops, and we're talking about like value as if like cash flow is the only way to get value, and I totally understand that point of view. And I spent a decade on Wall Street. The reality is value is what someone's willing to pay for it, right? And today, people see value in the tokens. Right? They are buying the tokens because they think there is value there. They think that they're not buying the tokens because, in some cases, maybe they're just like, oh, this is fun and I want to buy it and I want to be part of the governance. For the most part, people say there is value in this token. So I think it's short-sighted and very, old school of us to be like, if there's no cash flows and I can't put a DCF on it and put 7 times PE on it, then it has no value.
I disagree. They see a speculative value. They don't see actual real value. They see speculative value. That's why people trade on crypto.
What's the difference? You work at a hedge fund. People are talking about
Sure.
Please go on our website and look at our DCFs for our favorite tokens. We are definitely looking at intrinsic value here.
You're looking at DCFs, and I think a lot of us would
zero. You're the DCF.
But your point is interesting because, like, whatever that frog token was, and the dog token, and like
Pepe.
Yeah, people seem to find value in these. That's fair. I don't get it, but it's a fair point.
You didn't own the dog token?
I actually did own the dog token once, but I don't anymore.
Okay, we are out of time. Thank you to our wonderful panelists. Thank you to everyone in the room.
To end it on.